It's Brian Preston, the Money Guy.
Jay has a question. He says, can the Money Guys compare and contrast after-tax 401k contributions versus brokerage accounts in step 7 of the financial order of operations? There seems to be pros and cons for both. What do you guys think?
So I'm gonna give a little teaser first, and then we'll answer your question. We actually do a pretty deep dive of this in the course. If you've not actually checked out the financial order of operations course, go check it out. Learn.moneyguide.com. We talk a lot about after-tax 401k, what that is, how it works, and we talk a lot about brokerage and how to kind of think about the two different ones and where they may or may not make sense. I think a lot of people in hyperaccumulation think about this. Hey, I could do after-tax, so perhaps it makes sense to talk about what is after-tax, who's it available to, how is it best utilized, because it can be used and not utilized best, and then we can talk about brokerage and what that is.
Well, even though these accounts sound very similar, is you have after-tax brokerage account, whether it's an individual or joint account, and then you have after-tax savings in your retirement account if you have a very specialized retirement plan, a 401k, 403b, that allows after-tax contributions. They sound so similar, I can see how Jay can get these kind of worked up. But what they're doing are completely different things. And let me explain. The after-tax within your retirement plan is a very specialized strategy, but it's not to actually build up like brokerage assets or after-tax assets. It's actually to be a mega backdoor Roth contribution.
When it's used in its most effective manner.
Yeah,
a lot of people
because
don't do that. They miss that whole step of it. They just put money in the after-tax and never finish the drill on the Roth side.
Well, because that's why when we're going through the decision matrix of what is the right things when you're analyzing your employer's after-tax opportunities, is you are saying, hey, do they allow either in-service distributions, meaning I could roll it out into a Roth IRA and do a conversion, or is there an opportunity for me to do a conversion within the plan? And realize because it's after-tax contributions, you don't have a tax consequence. Yeah. You actually get to put a lot of money into that tax-free Roth account.
Yeah, we've seen a number of clients come in and say, hey guys, I heard you talking about the after-tax. I've been listening to you for a number of years, and I've been doing it. And we look at their 401k, and they have a lot of after-tax dollars that are built in there, but they didn't do the next step. They didn't do the actual next part, because all that happens when you do after-tax contributions in your 401k is your contributions go in after tax, but while those dollars are invested, it just grows tax deferred, just like the other parts of your 401k. Unless you actually get it shifted into the Roth bucket or you do an in-service distribution, it's not tax-free growth. It's just more tax-deferred growth. It's an important distinction to make that I don't think most people often recognize is there.
And then, so that's kind of, so we know when we see after-tax contributions within your employer plan, that is a mechanism or a way to potentially get us huge Roth contributions. Now, remember, let me give you the disclaimer on what the catch is. Don't squeeze out the employer money.
That's right.
Because, you have these limits that the government lets you do every year. We're right around $60,000 right now. That's everything. That's your contribution. That's your employer's contribution. So you don't want to squeeze out and put too much money into the after-tax with the thought of turning it into Roth, and then you squeeze out that profit sharing or the matching funds. Just be careful with that. Now, your after-tax brokerage account, that's your individual joint account. That's money that you probably are taking advantage of the tax treatment of like qualified dividends, but it's also for liquidity purposes. This is going to be your bridge account if you retire at a very young age, or if you want the ability to pay cash for your next vehicle or any other big purchases. So hopefully, Jay, that distinction, they sound very similar, but they have completely different purposes in your financial toolbox of how you're trying to build independence.
And the use and application is very, very specialized on which one makes sense. We have clients where we will recommend, yes, we need to fully take advantage of the after-tax mega backdoor Roth because it makes the most sense. And we have other clients who say, hey, it makes sense for us to forego that, and we need to start building after-tax assets. That is one of those areas that if you are saving in that level and you are at a stage of life where you're trying to make those decisions, that might be an indicator that you should potentially consider taking the relationship to the next level, because you want to make sure you think through that correctly. This is not one where it's like one size fits all. I'd argue that every case is very unique and very specific. If you want to know more about that, if you have specific questions, I'd encourage you to reach out, aboundwealth.com. You can go check out the Work With Us, we've got a ton of advisors here that would love to kind of walk you through whether that makes sense for you and the best way to approach making that decision.